Welcome back to Debit Credit Done, the podcast that turns accounting theory into practical exam-ready knowledge. I'm your host, Dean Quartermain, and this is episode 2 of Series 2, where we're tackling the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. So on Monday in episode 1, we revisited the accounting principles and double entry system that underpins everything that we do within this module. So today we're going to move on to the next stage of the accounting cycle, the trial balance. So if we remember from our level 2 studies and from previous series that I put together, the trial balance is a checkpoint that we have before we make any adjustments. And it's where we can catch a lot of errors with our double entry, but certainly not all errors. So let's start very simple. So what is a trial balance? So a trial balance is a list of all the balances in the general ledger at a particular date, split into debits and credits. So it's designed to do two main things. One, check the arithmetic accuracy of your double entry bookkeeping. So your debit should equal your credits, and it's a good check to ensure that that's the case. The second thing that a trial balance is designed to do is provide the starting point for preparing financial statements. So we take the numbers out the trial balance, and as we've seen in previous episodes, we use those numbers after adjustments to create a statement of profit or loss and a statement of financial position. Now, in your AAT exams, you could be given a list of ledger balances and asked to create a trial balance, but more likely, certainly on the FAPS exam, more likely you're going to be given a partially completed trial balance and given some details about some errors that need correcting, some adjustments that need making, and put together what's known as an extended trial balance with those adjustments. So take the initial trial balance, make the adjustments, end up with what's known as an extended trial balance post-adjustment. So a trial balance then has, so what's the structure? Well, it has 3 columns, doesn't it? It's account name, debits, credits. Nothing more complicated than that. It's quite simple. Just the name of the account, debit balance, credit balance. Now, assets and liabilities would normally have debit balances. Liabilities, income and capital would normally have credit balances. So that just comes right back to our DEAD CLIC principles. So just as another reminder, because I talk about DEAD CLIC with my students all the time, I think it really does underpin AAT as a qualification. If you understand that, it's probably the key thing. If you can understand that, you're a long way along the way to being able to do most of the things you need to be able to do for the AAT qualification. So, DEAD. Debits increase expenses, assets and drawings. Now, lots of students say to me, yes, what happens then, Dean, if it's a decrease to expenses, assets and drawings? Well, it's just the flip opposite. So if a debit increases it, a reduction is a credit. And then credits, so the click part of DEAD CLIC, credits increase liabilities, income and capital. So it makes sense, therefore, that if you're decreasing liabilities, decreasing income, decreasing capital, they're all debit entries. So how do we build up a trial balance then? So let's just work through a quick example. So let's say we posted the following transactions into our accounting system for the month of March. So we've got rent expenses of £1,200 that we paid that, £1,200 being paid. We've received £8,000 in sales revenue. We paid £3,000 for the purchase of some new equipment. And the owner of the business, so in this case, let's just assume it's me. So I'm the owner of the business, and I've introduced £5,000 of my own money as capital into the business. So in the ledgers then, what we would have is we'd have some debit entries and we'd have some credit entries into our ledger accounts that are going to hopefully make up our trial balance. So the rent expense would show £1,200 in the month of March relating to rent expense, £3,000 relating to equipment from a debit point of view. And the bank, well, would the bank be a debit? The bank's an asset, isn't it? Generally. But it depends, doesn't it? Yeah, because the bank is reduced in value when we pay rent and equipment, but it increases when we receive the capital and the sales. So it could be an asset and have a debit balance, or it could be a liability and have a credit balance. We really, we don't have enough information here to conclusively say, because we don't know what the opening balance of the bank account was at the beginning of March. What we do know, however, is on a credit side, we'll have sales revenue, £8,000, and the capital introduced in March would be a credit entry into the ledger accounts. So if you listed all of those ledger accounts out and their final balances, and we total each of the columns, assuming it totals correctly on both sides, we can arithmetically say that our trial balance is arithmetically correct. However, as we've said before, all that confirms is debits equal credits. It does not confirm that all the entries are correct. We could have debited the wrong account. Could have got debits and credits the wrong way round. Now, anyone who works in the industry will have seen countless times people posting journals the wrong way round. It happens all the time. Yeah. Totals on the trial balance will match, it's just the entries are the wrong way round. So let's just talk a little bit around errors that trial balance can and can't detect. Now, this is covered on the Principles of Bookkeeping Controls unit at level 2. And then we obviously also talk about it here in the Financial Accounting module at level 3. And it's something that you do need to understand. You do need to understand what the errors are, which errors affect a trial balance, which ones don't, and what to do about all the different types of errors. So, as I've mentioned before, a trial balance is only a partial check. It only partially checks that everything's correct. It checks the arithmetic, doesn't it? It checks that debits equal credits. What it doesn't do is check that you've done everything correctly. So, we'll start with the errors a trial balance will detect. So a trial balance will detect single entry errors, i.e. you posted a debit but no credit, or a credit but no debit. If you've only posted one single-sided entry, it will definitely pick that up because debits and credits will be out of balance, won't they? It'll also pick up mathematical errors in accounts totals. So let's say that I add up the sales revenue account. So when I'm adding the total of a sales revenue account, I add it up incorrectly. Well, let's assume they're all cash sales. That money's gone in my bank account, and assuming that my bank account balance, I balanced that correctly and I've broke the right number down, it's going to be out of balance to that sales revenue I've generated, because debits won't equal credits again, will they? So mathematical mistakes in account totals will be picked up by a trial balance. And then equally posting unequal amounts to debits and credits. So if I posted, sales revenue as a credit, £5,000, and it was a cash sale, and I put £4,500 into the bank account, so debit bank account £4,500, credit sales £5,000, debits don't equal credits. Unequal amounts, and the trial balance will detect that there's an error there, because the totals on the trial balance for debits and credits will not match. Errors that it won't detect though, and these are probably the more important ones, because these are the ones where everything looks fine, doesn't it, from a trial balance perspective? Debits equal credits, but it's not right. So errors that trial balance won't detect, errors of omission. So if you've completely missed out a transaction, it will not be detected in your trial balance. So that's like, I've got this invoice in my hand here, and I put it on the table there, and I don't bother to process it. Well, we've omitted it. It won't be picked up by our trial balance, would it? Well, how would it? Because we just didn't do it. Next one's an error of commission. Now, an error of commission is posting to the wrong account, but the same type of account. So if we think about expenses, yeah, if I post an electricity expense to wages, yeah. So wages is an expense to a business. Electricity is an expense to a business. Now, if I post the electricity invoice to wages, it's wrong, isn't it? However, trial balance won't detect that because debits equal credits. Done it right, just wrong account. And it's an error of commission because it's still to an expense account, just the wrong expense account. Yeah? Now, not to be confused with this thing known as an error of principle. Now, an error of principle is posting to the wrong type of account. So, same example, got an electricity bill. We should post it to electric. What happens if I posted it to motor vehicles at cost? Yeah, motor vehicles at cost is an asset account, isn't it? It's an asset, right? So now it's not only is it posted to the wrong account, it's a wrong account of a totally different type. It's an asset account rather than an expense account. Yeah, that's known as an error of principle. Another thing that a trial balance won't detect, and these are, these can be difficult to track down, is a compensating error. That's where you've got two errors that cancel each other out. Yeah, so you might have an error where debits are higher than credits, and then you might have another one where credits are higher than debits, but the two things balance each other out. Yeah, so a trial balance will look like it balances, yeah, but you've got two errors that are just balancing each other out. Won't be detected by a trial balance. And then the one that I mentioned earlier that won't be detected by a trial balance is reversal of entries. So if you just get your debits and credits the wrong way round, yeah. So if we think about a cash sale, debit, bank, yeah, credit, sales revenue, yeah. Well, what happens if we just did it the other way around? What happens if we did credit, bank, debit, sales revenue? Totally wrong. However, trial balance will still balance. Yeah. So won't be detected on a trial balance. So what do you do if your trial balance doesn't balance then? So if your trial balance, you put all your entries in, you've done all your, you've done all your ledger accounts, you've taken all your balances from your ledger accounts, wrote them down in big long list, account names, debits and credit balances, added it all up, got to what it don't balance. What do you do? Well, if your trial balance doesn't balance, the first thing you need to do is post the difference to what's known as a suspense account. Now, suspense accounts are temporary accounts. Yeah, and it allows you to almost draft a financial statement whilst you investigate the discrepancy. Now, what I will say is suspense accounts should not exist. There should be no suspense account balance at the point of the creation of the financial statements. The issue needs to be resolved. You need to find out what the problem is and fix it. Yeah, you should not draft a set of statutory financial statements with a suspense account balance. Yeah. Now, I've worked in the industry for a long time, and I've seen businesses that have large suspense account balances that roll over year end. Now, you shouldn't be doing that. You should temporarily post it into a suspense account, and very soon after that, fix it. Find out what the problem is and fix it. The longer you leave it, the harder it is to resolve it. Yeah. Now, not going to really look at suspense accounts today. We're going to do that in a later episode. We'll look at how to clear suspense accounts by finding and correcting the underlying errors. That is a skill. It is something that you need to be able to do for the FAPS exam. The chances are you are going to have a question with a suspense account balance, some corrections that need to be made that will remove that suspense account balance, and you need to understand what it is you need to do. So just a quick recap then of what we've covered today. So we've covered today what a trial balance is. So a trial balance, just for memory, a trial balance is just a list of balances brought down on ledger accounts. Yeah, so it's just a list of brought down balances of ledger accounts at a period in time. Yeah, why do we use it? Well, we use it firstly as a check that our double entry is correct, and also as the starting point for the preparation of financial statements. How do you structure it? Well, again, it's just literally account name, debit and credit balances, but it follows that DEAD CLIC principle. Yeah. So assets would ordinarily be debits, liabilities would ordinarily be credits, yeah, and so on and so forth. We talked about what errors it can and can't detect. Yeah, so went through all those errors that it can and it can't detect. So the ones that it can detect: single entry errors, mathematical mistakes in account totals, the posting of unequal amounts to debits and credits. All of that will be picked up by a trial balance. The things that can't be picked up by a trial balance: errors of omission, it's just not there, is it? Errors of commission posted to the wrong account of the same type. Error of principal, posting to the wrong type of account, so that's posting expenses to an asset account. Compensating errors, two errors that balance each other off. Yeah. And then a reversal of entries where debits and credits are just the wrong way around. And then we talked about the role of a suspense account. So suspense accounts, really, its role is to be able to post that difference. If you've got a difference on your trial balance, it doesn't balance, post a difference to the trial balance. It allows you then to draft some financial statements whilst you investigate what that suspense account balance is. But as I say, you should never produce a signed off set of statutory accounts with a suspense account balance. Make sure you clear the suspense account before you create the financial statements. So within the AAT exam then, being confident with a trial balance is important. There's a large task on there with an extended trial balance task. Being able to do that carries quite a significant amount of marks. It's a skill, and it's one that, if you read the examiner's report, it's one that students are not that good at doing. So if you can master that, you're a long way towards where you need to be in order to succeed on that unit, and it'll also set you up for, work in industry, work in practice, and for further study. Yeah. So, challenge before the next episode on Monday then. So, challenge before we look at episode 3 is as simple as this. Take 5 example transactions from any business scenario you like and record the debit and credit in a set of T accounts for each of those transactions. Then I'd like you to produce a trial balance from those ledger postings. Make sure it balances. Hopefully it will. If it doesn't, try and spot the error. If it does, great. Yeah, you've created a trial balance. So that is it for episode 2 of series 2 of Debit Credit Done. Yeah, on Monday in episode 3, we'll explore non-current assets and acquisitions and disposals and start looking at depreciation policies and different ways we can depreciate assets. Until then, Debit Credit Done.